Welcome back to the deep dive. This is where we, take a whole stack of sources, really dig through them, and try to pull out the most important bits, the real knowledge nuggets just for you.
And today, we're doing exactly that, focusing specifically on corporate governance,
Mhm.
particularly in, well, the bigger companies.
Right. We'll be looking at the key issues they face, how they're held accountable, or how we try to hold them accountable, and also that really fundamental debate, isn't it? About whose interests they should actually be serving.
Yeah, it's a big one. And look, this deep dive, it's specifically designed to help you get your head around this material. We're drawing directly from the sources provided.
The ones you're likely studying.
Exactly, to help you prepare for your studies and especially for those upcoming exams.
And we absolutely have to give credit where it's due. We're incredibly grateful to the University of London for making these documents available for educational purposes. It's fantastic they make this knowledge so accessible.
It really is. Their contribution is vital.
And this deep dive is brought to you by Sinorbit Academy, Sri Lanka. And from both of us, seriously, we wish you the very, very best for your studies and, of course, for your exams. Good luck.
Definitely. So think of the next few minutes as a guided tour through this material. We'll start with some classic ideas that kind of set the scene.
The historical context.
Yeah, then we'll move into the more practical stuff, the mechanisms for accountability, and then we'll grapple with that core theoretical question right at the end.
Okay, sounds like a plan. Let's jump in. So the sources kick off by looking at what makes these really big public listed companies, well, different.
They do, and they immediately take us back to some really landmark research. 1932 Berlin means.
Berlin means, okay, names to remember.
Definitely. They looked at the big U.S. corporations back then, but their findings still incredibly relevant, especially for understanding the UK's setup.
So 1932, what was the big discovery? What did they notice about who owned these massive companies?
Well, their first key observation was about dispersed ownership. Instead of just one person in a family owning a huge chunk.
Like in smaller businesses, maybe?
Right. In these big public companies, ownership was spread out. Thousands, maybe tens of thousands of shareholders, each holding just a tiny little piece of the pie. It was really scattered.
Okay, so no single owner calling the shots. What does that lead to if ownership is so spread out?
It leads directly to this crucial concept, the separation of ownership and control. Think about it. The shareholders technically own the company.
Right, on paper.
But because their ownership is so fragmented, they can't realistically exercise control. So who does? The managers. The executives running the show day to day. Berlin Means reckoned managers controlled something like 65% of the big companies they studied.
Right, I get it. If I've got like 10 shares in some giant corporation, I'm not exactly phoning up the CEO with instructions. So the managers are basically in control because no one else realistically can be.
That's pretty much it. And this separation, it immediately throws up a huge question, particularly in places like the UK and the US where this pattern is common. How do you make sure those managers, the controllers, are actually accountable to the owners, the shareholders?
Ah, okay. Because if the managers have all the power, what stops them from, feathering their own nests instead of looking after the shareholders?
That is the absolute core concern, that managers might put their own interests first. And this leads to what economists call agency costs.
Agency costs, another key term.
Yep. And it can mean anything from, well, managers just not working very hard, sort of shirking.
Slacking off.
Yeah, or incompetence, right through to lining their own pockets, think massive salaries, bonuses not linked to performance, pursuing vanity projects that don't help the company make money for its owners.
And the sources mention that, okay, we have existing company law like directors' duties.
We do.
But maybe that's not always enough on its own to fix this accountability gap in these huge dispersed companies.
That's a really important point. Those legal duties exist, absolutely. But actually enforcing them can be, well, tricky, especially for those small, scattered shareholders. Things like derivative claims, where shareholders sue the directors for the company.
On behalf of the company.
Exactly. They're just not used very often, or they're really hard to get off the ground.
So this gap, this accountability problem, which stems from that separation of ownership and control that Berlin Means first highlighted, that's really why we've seen all these other corporate governance mechanisms develop. Things trying to bridge that gap.
Absolutely. Trying to increase that accountability. But hold on. Before we get into those mechanisms, Berlin Means had a second big observation, didn't they? This one wasn't just internal.
Ah, yes, the outward-looking one. Not just owners versus managers, but the sheer size and power these companies have in the world.
Precisely. As these corporations got bigger and bigger, they gained enormous economic power, social influence, even political clout, because they're to, individuals or groups outside the company, employees, customers, communities, the environment.
Suppliers, too.
Suppliers, definitely. For the really huge multinationals, their economic weight can be bigger than some countries.
That's a staggering thought. A company being that powerful, and the source explains this leads to a whole different debate about governance, doesn't it?
It totally shifts the focus. It's not just how do we make managers answer to shareholders anymore. It becomes, hang on, whose interest should an entity this powerful actually be serving? Should it only be about shareholder profit? Or do the interests of all these other affected groups, the stakeholders, need to be considered too?
Okay, so that sets up the big theoretical clash we'll get to later. So just for your exam prep, let's nail this down. Remember, Berlin and Means, two key ideas. One, dispersed ownership causes separation of ownership and control. This creates agency costs and the problem of manager accountability to shareholders.
Got it.
Two, the immense power of large companies raises the separate question of accountability to stakeholders.
Got that crystal clear. So, with that Berlin means foundation laid, let's look at how the UK system tries to tackle that first problem, getting managers more accountable to shareholders. Section 14.2 in your notes.
Right, specific mechanisms. And the first one they tackle is executive pay. Remuneration. Always controversial.
Oh, yeah, it's often a lightning rod, isn't it? People see massive pay packages and think, well, that's just proof the system's broken. It's a symptom of bad governance.
Yep.
Managers enriching themselves.
But the source makes an interesting point. Pay could also be part of the solution.
It could, if designed smartly. The theory is pay for performance. You structure the pay package salary, bonuses, stock options, whatever, so that the executives only get really big rewards if the company does well for the shareholders. The goal is to align their interests.
Align interests. Makes sense. If the CEO gets rich only when I, the shareholder, get rich, then they'll work for me. But what are the catches? It can't be that simple.
No, it's not. The sources flag two big problems. First, what even is good performance? Is it just hitting financial targets? Or should it include, say, environmental performance, employee satisfaction? That links back to the stakeholder debate again.
Right.
And second, even if you set performance targets, how do you stop the executives from basically setting their own pay anyway, or gaming the system to get huge rewards, even if the performance isn't really that great?
Okay, and the UK system has ways to try and stop that self-awarding problem.
It tries. Three main approaches are mentioned. First, independence in the pay-setting process itself. This comes mainly from SOS law that's important, soft law, particularly the UK Corporate Governance Code. It pushes companies to have a dedicated remuneration committee.
A specific committee just for pay. Who's on it? Not the executives themselves, surely.
No, that's the key. The code says it should be made up of independent, non-executive directors, NEDs. We'll talk more about NEDs in a sec. But crucially, they're meant to be independent of the managers whose pay they're setting.
Okay, independence via NEDs on a committee. What's number two?
More information. Transparency. Quoted companies have to publish these really detailed remuneration reports every year. Spells out who got paid what and how, so shareholders can actually see what's going on.
Got it. And number three, giving shareholders a voice.
Exactly. Say on pay. Shareholders get to vote on these remuneration reports. And the big change came in 2013. The vote on the company's future pay policy became legally binding.
Ah, so not just advising, but actually blocking a policy they don't like. That gives it teeth.
It does. And there's one more recent thing. The source mentions the company's miscellaneous reporting regulations 2018.
Right. What did they add?
They brought in this requirement for quoted companies to publish the ratio between their CEO's total pay and the median or average pay of their UK employees. Another transparency measure, really, designed to highlight potential unfairness.
Okay, lots to remember there on executive remuneration. For the exam, goal is pay for performance to align interests. Issues are defining performance and stopping self-awarding. Mechanisms are independent remuneration committees with NEDs, mandatory remuneration reports, and shareholders say on pay. Binding policy vote since 2013, plus that Companies Act 2018 CEO pay ratio disclosure.
Nailed it. Okay, second mechanism. Looking at the board itself. Re-engineering the board of directors.
This feels logical. If the board's job is oversight, let's make the board better at it. How?
Well, the aim is exactly that. Make the board better at overseeing, reviewing, monitoring the executives. And the focus has been on sort of two things. Who is on the board, its composition, and how it's structured.
Okay, composition first. The big idea here seems to be more independent, non-executive directors, NEDs. What's their role exactly? How are they different from the executives?
So executive directors are the full-time managers running the company. NEDs are part-time outsiders. They come in for board meetings, maybe sit on committees. Their job is to bring independent judgment, to challenge the executives, to monitor performance from a, well, slightly detached perspective.
But the sources suggest there's a bit of a debate about whether NEDs are actually effective.
There is. The pros are, they often bring loads of experience from other businesses. And using NEDs is a form of self-regulation by the company, which some prefer to heavy-handed external rules. It can be more flexible.
And the cons, the weaknesses.
Well, they're only part-time, right? So how much can they really know compared to the full-time execs? Do they have enough information? And what about their incentives? Are they really motivated to rock the boat and challenge management? Or might they just want to keep things friendly? Some critics even say they can make the board feel a bit us and them.
Interesting balance. Okay, what about the structure changes?
The main structural shift is using board subcommittees.
Yeah.
We already mentioned the Remuneration Committee. The other key ones highlighted are the Audit Committee, which oversees financial reporting and the auditors, and the Nomination Committee, which handles appointing new directors. Splitting up the work allows for more focus.
More focus and maybe more independence in those crucial areas like pay and audit.
That's the idea.
Yeah.
And how have these changes, more NEDs, committee structures, been pushed in the UK?
You said earlier soft law, the UK Corporate Governance Code, UKCG code.
Exactly. That's the main driver.
This code sounds really important. Give us the quick history. Where did it come from?
It really kicked off in the early 90s. There were some big corporate scandals.
The usual trigger.
Pretty much. So the Cadbury Committee reported in 1992 recommending more NEDs, the committee structure we just talked about. Then there were other committees, updates. It became the Combined Code, then eventually the UKCG Code. The Financial Reporting Council, the FRC, oversees it. The latest version just came out in Jan 2024, though remember the FRC is due to become a new body called ARGA.
FRC becoming ARGA, okay. And the code's philosophy, how does it actually work? Does it just lay down strict rules?
Not exactly strict rules. It sets out principles, broad goals, and then more specific provisions. It focuses on board structure and composition, like having enough independent NEDs. But its mechanism is comply or explain.
Comply or explain, we hear that a lot. What does it mean in practice?
Companies listed on the stock exchange have to state in their annual report whether they've complied with the code's provisions. If they haven't complied with a specific provision, they must explain why not. They also have to report on how they've applied the overarching principles.
So it's flexible, but requires justification for not following the standard approach. Is it effective? Does this soft law comply or explain thing actually work?
Well, that's the million-dollar question, isn't it? The sources lay out the arguments. On the yes side, companies were involved in creating it, so maybe less resistance is on plain English, not legalese. The market can punish companies with poor explanations. Investors might sell shares. Compliance rates are actually pretty high, and you can update it faster than changing laws.
Sounds plausible. What about the no side, the criticisms?
The big one is the lack of teeth, no formal legal sanctions if you just explain away noncompliance. Some worry that companies or executives have too much influence over what goes into the code. And unlike laws passed by Parliament, it doesn't have that same democratic legitimacy.
Okay. And one last thing on board diversity. That's become a much bigger focus, hasn't it?
Hugely. It started really with gender diversity. You have the Lord Davies Review setting targets for women on FTSE 100 boards, targets, which were largely met, actually.
Good news.
Yeah. And now the focus is widened. Ethnic diversity is a big push, thanks to things like the Parker Review. And diversity in broader terms, too. Skills, background. The latest code makes companies report on their diversity policy and their progress towards their own objectives. It's definitely embedded now.
Right. Vital exam points on board reengineering. Goal, better oversight. Key terms, NEDs, role, prospons, subcommittees, remuneration, audit, nomination, absolutely crucial. The UK Corporate Governance Code, UKCG code, know its history, Cadbury, its soft law nature, the comply or explain approach, FRRGA. Be ready for the effectiveness debate, pros cons of comply or explain, and don't forget board diversity, Davies, Parker Reviews.
Perfect. That leads us nicely to the third accountability mechanism, getting the shareholders themselves more involved, shifting the focus.
So not just relying on the board, but pushing the owners, the investors, to take more responsibility. How does that work?
This is where the stewardship code fits in, also from the FRC, and it got a major revamp in 2020.
The stewardship code. Okay, what's its main goal?
It's aimed squarely at the big institutional investors. Think pension funds, insurance companies, the huge asset managers who look after trillions of pounds. The code wants them to be active stewards of the companies they invest in.
Stewards, meaning more than just buying and holding share.
Exactly. It means engaging with companies, monitoring them, voting their shares thoughtfully, intervening if necessary, not just being passive bystanders.
What prompted this? Where did the stewardship code come from?
A lot of it stemmed from the fallout of the 2008 financial crisis. The Walker Review, which looked at bank governance, was pretty critical of institutional investors. Said they'd failed to exercise their stewardship responsibilities, basically hadn't kept a close enough eye on the companies they owned.
So the code applies to those big institutions, the asset managers, anyone else.
Yes. Also service providers who support them, like proxy advisors who recommend how to vote.
And how does the code define stewardship? It sounds quite broad.
It is. It talks about the responsible allocation, management, and oversight of capital for long-term value, leading to sustainable benefits for the economy, environment, and society.
Wow. Sustainable benefits for the economy, environment, and society. That language definitely echoes the stakeholder side of the debate we mentioned earlier.
It certainly seems to lean that way, much more so than older versions, and it shows up in the principles. Signatories have to report annually using an apply and explain approach similar to the governance code, but focused on their activities against 12 principles.
Apply and explain. Got it. Any specific principles worth noting?
Well, Principle 7 is quite significant. It explicitly requires them to integrate environmental, social, and governance ESG factors, including climate change, into their investment decisions and their stewardship work. That's a big signal.
Okay, so for the exam, distinguish the UKCG code, boards, from the stewardship code, investors. Know the stewardship code's purpose, institutional investor engagement, who it applies to, the Walker Review context, and the apply and explain reporting. Remembering Principle 7 on ESG is probably a good detail, too.
Right. So we've looked at all these mechanisms designed mostly to make managers more accountable to shareholders. But doing that really forces us back to that fundamental question from Burl and Means' second point.
The big one, Section 14.3 in your material. Whose interests should companies actually serve? The showdown. Shareholder primacy versus stakeholder theory.
Exactly. The traditional view, the one that's really shaped UK company law historically, is shareholder primacy. Basically, the company exists primarily, maybe even solely, to make profits for its owners, the shareholders.
Simple enough. What's the counterargument?
That comes from stakeholder theorists. They say, hang on, companies affect lots of people, not just shareholders. Employees, customers, suppliers, the local community, the environment, they all have a stake. So companies should consider all these interests, try to balance them.
No, the source material is careful to clear up a couple of common mix-ups about this disagreement. What's the first one?
The first is thinking that shareholder primacy people just, ignore everyone else. That's usually not the case. They consider stakeholders, but, and this is the key word, they consider them instrumentally.
Instrumentally. What does that mean? How's it different?
It means they see looking after stakeholders as a tool or an instrument to achieve the main goal, maximizing shareholder profit. So they might pay good wages or invest in cleaner processes because it builds reputation, attracts talent, avoids fines, and ultimately makes more money for shareholders in the long run.
Okay, so it's a means to the end of profit.
Precisely. Stakeholder theorists, though, see stakeholder interests as an end in themselves. They think directors should genuinely weigh up everyone's interests and find a balance, even if doing right by, say, employees means slightly lower profits for shareholders in a given year.
Right, so the reason for considering stakeholders is different. Tool for profit versus intrinsically important. What's the second common confusion?
It's about regulation. Some think shareholder primacists are against any rules limiting companies. Not true. They generally favor constraints, but they prefer those constraints to come from external regulation.
You mean laws passed by government, like environmental laws, employment laws, consumer protection laws?
Exactly. The shareholder primacy camp says, let Parliament set the rules of the game through law. Within those rules, the company's job is to maximize profit for the owners, and the owners should have control.
And the stakeholder theorists don't think external regulation is enough.
Generally, no. They argue external laws are often too slow, too easy for powerful companies to lobby against or find loopholes in, or hard to enforce effectively. They often want changes inside company law itself.
Like changing directors' duties so they legally have to balance stakeholder interests, not just focus on shareholders. Or even giving stakeholders some kind of formal say in how the company is run.
Yes, exactly. Those kinds of internal governance changes. So to recap that core debate, super important for exams, shareholder primacy.
Yeah.
Focus on profit. Stakeholders are instrumental, shareholders control, rely on external regulation. Versus stakeholder theory. Balance interests. Stakeholders are ends in themselves, maybe give stakeholders some control, view external regulation as insufficient. Got it.
Got it. That distinction is crucial. Then the source briefly touches on different ways people have thought about what a company actually is, theories of the company. Do these help settle the debate?
They kind of inform it, but the source suggests they don't completely resolve it. You've got the old fiction concession theory. The company is just an artificial thing created by the state. That justifies state regulation, but doesn't really pick a side between shareholders and stakeholders.
Okay.
What else? Then there's corporate realism. This view sees the company as more like a real social entity, an institution with its own existence and maybe its own responsibilities.
And wasn't there a name associated with this? Dodd.
Yes. Dodd, back in 1932 again, used this idea of corporate realism to argue that big companies had wider social responsibilities, like being good citizens, beyond just making money for shareholders. So realism tends to lean a bit more towards the stakeholder perspective.
Interesting. And the view that's more dominant today?
That's the aggregate theory, or more commonly the nexus of contracts theory. This sees the company less as a thing and more as just a web or nexus of contracts between different individuals, shareholders, managers, employees, lenders, suppliers.
So just a bunch of contracts.
Essentially. And while this is the prevailing academic view, the source points out that just saying it's a nexus of contracts doesn't automatically tell you whether shareholders or stakeholders should come first. You need to add some economic analysis on top of that.
Okay, so for exam purposes, be aware of the main theories. Fiction, concession, realism, aggregate nexus. Remember, Dodd linked realism to broader corporate responsibilities, but understand these theories are more background context than a definitive answer to the shareholder-stakeholder fight.
Exactly. Which brings us neatly to the economic analysis of company law. This is often used to build the case for shareholder primacy, starting from that nexus of contracts idea.
Okay, how does the economic argument work? Why shareholder primacy?
The argument goes like this. Everyone involved makes a deal, a contract. Employees get wages, lenders get interest. These are usually fixed, pre-agreed returns. They're relatively safe. But shareholders, they're the residual claimants.
Residual claimants, meaning they get what's left over.
Precisely. After all the contractual obligations are paid wages, suppliers, interest, whatever profit or loss remains, belongs to the shareholders, they bear the main financial risk. If the company does badly, they might get nothing or even lose their investment. If it does well, they get the upside.
So because they bear this unique residual risk?
The economic argument concludes that shareholder primacy is the most efficient setup. Having directors focus on maximizing that residual profit and giving shareholders ultimate control is seen as necessary to induce people to invest their capital in the first place. Why take the biggest risk if you don't also get the primary focus and control?
Makes intuitive sense. And how does this economic view see the other stakeholders being protected if the focus is all on shareholders?
Through their specific contracts, wage agreements, loan terms, etc., and through that external regulation we talked about, minimum wage laws, safety standards, environmental rules. The argument is that this combination of contracts and external law is a better, more efficient way to protect stakeholders than trying to make directors serve multiple masters internally, which might just confuse things and reduce the incentive to invest.
Okay, that's the economic case for shareholder primacy. But stakeholder theorists don't buy it, right? What are their main criticisms?
They raise some strong points. First, they ask, do shareholders really only care about maximum profit? What about ethical investors, impact investors, people who want companies to behave sustainably, even if it slightly reduces financial returns?
Good point. What else?
Second, they really challenge the idea that contracts and external laws actually provide effective protection for stakeholders. Are employment contracts always fair when there's unequal bargaining power? Are environmental laws strong enough or enforced well enough? They argue that maybe a company that only focuses on profit and ignores trust with stakeholders might actually end up less profitable long term.
Interesting paradox. And the third criticism?
It comes back to the limits of external regulation. It's often slow, reactive, can be lobbied against by powerful companies, or dodged through things like insolvency. So relying only on external rules might not be enough.
Right, so for the exam again, understand the economic case FOR shareholder primacy based on residual claimants inducing investment. Know how it says stakeholders are protected, contracts plus external reg. But critically, know the stakeholder criticisms, do shareholders only want profit, are contracts external reg effective, limits of external reg, long-term profit impact.
Absolutely key distinctions. And finally, the source material does something really helpful for exam prep. It gives you a classic case to hang these ideas on. Dodge v. Ford Motor Company, a U.S. case from 1919.
Dodge V4. Okay, another one to remember. Why is it so important?
Because it contains this incredibly clear, almost pure statement of shareholder primacy. The judgment famously said something like, a business corporation is organized primarily for the profit of the stockholders, and directors' powers must be used for that purpose.
Wow, doesn't get much clearer than that. And the source uses this as a sort of sample exam question prompt.
Exactly. It asks you to consider if that principal profit for stockholders above all else would still hold entirely true if you applied it to UK company law today.
So how should you approach that kind of question based on the source's advice?
Well, first you acknowledge the history. Yes, UK law has traditionally been very shareholder-focused, very much in the spirit of Dodge v. Ford. That's your starting point.
But then you qualify it.
You have to. You'd mentioned that even within that traditional framework, UK courts have sometimes found ways to allow actions that benefit stakeholders indirectly. But the crucial step is to then bring in the whole shareholder versus stakeholder debate.
Yeah.
We just went through the arguments, the economic analysis, the criticisms.
Apply all that theory to the Dodge v. Ford statement.
Precisely. You discuss whether that 1919 principle still fully captures the complexity of UK corporate governance now, given how thinking has evolved, given the existence of things like the UK Corporate Governance Code, which, although the source doesn't spell it out here, pushes directors towards considering wider factors under Section 172 of the Companies Act.
And the Stewardship Code with its talk of sustainable benefits.
Exactly. And just the fact that this debate is ongoing. So you evaluate how true is Dodge v. Ford today in the UK context.
Okay, so strategy for exams. Memorize the Dodge v. Ford 1919 principle as the classic shareholder primacy statement. Use it as a launchpad. Discuss the traditional UK focus, the nuances, judicial discretion. Dive deep into the shareholder versus stakeholder debate, theory, economics, criticisms, and consider how mechanisms like the UKCG Code and Stewardship Code might modify or challenge that pure 1919 view in modern UK practice. It really ties the whole topic together.
It's a great way to structure an answer, pulling in all the different strands we've discussed.
Phew. Okay, we have definitely covered a lot of ground there, working right through your source material. We started with Berlin means, didn't we? Dispersed ownership, separation of ownership and control, leading to agency costs. Foundational stuff.
Foundational, absolutely. Then we dug into the UK's toolkit for shareholder accountability. The UK Corporate Governance Code shaping boards with NEDs and subcommittees, trying to fix executive remuneration through pay for performance, transparency, and say on pay, and encouraging investors to step up via the Stewardship Code.
And then we hit that huge underlying question, shareholder primacy or stakeholder theory. Looking at different theories of the company, the economic arguments for shareholder focus, and the really important stakeholder criticisms of that economic view.
Finishing with how to apply it all, using that Dodge v. Ford case as a touchstone for the traditional view versus the modern reality.
So as you go back over your notes, really focus on those key terms we've kept repeating. Berlin means separation of ownership and control, agency costs, UK Corporate Governance Code, Stewardship Code, shareholder primacy, stakeholder theory, Dodge v. Ford. Knowing those concepts cold will be a massive help for your exams.
Definitely. Look, we hope this deep dive has helped you navigate the key arguments and knowledge nuggets in the material, built your understanding, and made you feel a bit more prepared.
We really do. We wish you all the best with the rest of your revision, and sincerely, good luck. Really good luck with those exams.
And just to leave you with a final thought, something to chew on. We talked about the stakeholder criticisms of the old economic arguments. Thinking about today's world, with ESG, environmental, social, governance becoming such a massive focus for investors, regulators, and society, how might those stakeholder criticisms become even more powerful, even more practically relevant for how companies need to operate in the future?
That's definitely something to mull over.